Every 4 years or so, a number inside Bitcoin's software gets cut in half. Nobody votes on it, no committee approves it, no one holds a press conference. A counter quietly reaches a threshold, the payment made to Bitcoin miners drops by 50%, and the entire thing happens exactly as somebody wrote it down in 2009 and then walked away. It has happened 4 times, and each time, over the following year or so, the price did something fairly theatrical. That correlation is where the famous 4-year cycle comes from. It is repeated with enormous confidence, frequently by people who could not tell you what a block subsidy is if you offered them money. So this video is about the mechanism, what actually changes at a halving, why it ruins the month of everyone who mines Bitcoin for a living, the 4-phase pattern it supposedly produces, what the historical record genuinely shows, and the bit nobody mentions, which is that the whole effect is mathematically guaranteed to get weaker every single time it happens. None of this is a prediction, and none of it is advice. It's just how the machine works. You don't need to own any Bitcoin for this to be worth 13 minutes. Bitcoin is the first widely adopted asset with a completely transparent, pre-announced supply schedule. Everyone knows exactly how much new supply will be created and exactly when, decades in advance. There is no discretion involved anywhere. That is deeply unusual. Gold miners dig faster when the price goes up. Central banks change their minds. Oil producers open the taps or don't, depending on the mood in Vienna. Bitcoin does none of this. The issuance schedule is fixed in code and completely indifferent to whether anyone wants any, which makes it a genuinely interesting experiment. What happens when supply is perfectly predictable and completely unresponsive to demand? Understanding the mechanism means you can assess the confident claims people make about it, rather than simply believing whoever spoke last. Bitcoin has no central bank. There is nobody deciding how much of it should exist this year. New coins enter circulation through mining. Computers around the world compete to solve a computational puzzle roughly every 10 minutes. The winner gets to add the next block of transactions to the chain, a block being nothing more exotic than a batch of transactions bundled together, and for their trouble, they're paid in newly created Bitcoin. That payment is called the block subsidy. At launch in 2009, it was 50 coins per block. The code also sets a hard ceiling, 21 million coins, ever. And to arrive at that number on schedule, rather than overshooting it, the subsidy is cut in half every 210,000 blocks. At roughly 10 minutes a block, that lands at about once every 4 years. That cut is the halving. It sounds like something from a horror film. It is, in fact, an accounting adjustment. 50 coins per block at launch, 25 in 2012, 12.5 in 2016, 6.25 in 2020, 3 1/8 in April 2024. The next one, due in 2028, takes it to roughly 1.5. Keep halving a number and it approaches 0 without ever quite getting there. The final fractions of a Bitcoin are projected to be mined around the year 2140, comfortably somebody else's problem. Mining is a capital-intensive business with fixed costs that do not negotiate. Warehouses full of specialized machines running continuously, industrial electricity contracts, cooling, because a room full of computers is essentially a very expensive radiator, hardware that becomes obsolete at an impressive rate. All of that is paid for in ordinary money. The revenue arrives in Bitcoin. So miners sell, steadily, mechanically, every month, simply to keep the lights on. Now run a halving through that business. Picture an operation producing 10 coins a month against, say, $400,000 in monthly costs. The morning after the halving, the same warehouse, the same machines, and the same electricity bill produce 5 coins. The revenue halved. The costs did not get the memo. Some operations absorb it. Those running older hardware or thinner margins simply can't, and they switch off, which is why mining difficulty tends to fall in the weeks after a halving, as machines quietly disappear from the network. Either way, the flow of new coins reaching the market drops sharply, on a date that has been publicly known for years. That's the supply shock argument in full. If demand stays where it is, while new supply is cut in half, basic economics points in one direction. It's clean, intuitive, and easy to explain at a party, which is a substantial part of why it's so widely believed. The cycle is usually described in 4 phases, worth knowing because nearly all the commentary you'll encounter is built on this frame. Accumulation, the aftermath. Price drifts sideways for months, occasionally longer. Retail interest evaporates, search volume falls off a cliff, and somebody writes another article declaring Bitcoin dead. This is roughly the 400th such article. The pre-halving run-up. As the date approaches, the coverage returns, analysts publish forecasts, everyone remembers what happened last time with tremendous clarity and very little precision. The post-halving bull market, the theatrical phase. New all-time highs, mainstream coverage, retail money returning, and alternative cryptocurrencies rallying shortly after Bitcoin moves, largely because people reinvest their winnings into increasingly speculative things. The bear market. Sentiment turns, leverage unwinds, and a substantial correction follows, historically 50 to 80% from the peak, over a year or more, which returns you to accumulation, and the whole thing begins again. One caveat worth holding on to. This is a description of what has happened, not a timetable of what must happen. It is a shape drawn around a small number of past events after they were safely over. The historical record as a matter of fact rather than forecast. After the 2012 halving, Bitcoin went from roughly $13 to a peak near $1,150 in late 2013. After 2016, from the low hundreds to nearly 19,700 by December 2017. After 2020, from around 8,000 to just under 69,000 in November 2021. After the April 2024 halving, it reached an all-time high in October 2025, followed by a substantial correction. In each case, the peak arrived roughly 12 to 18 months after the halving and was followed by a steep drawdown. That is the entire evidentiary basis for the 4-year cycle. 3 completed cycles. However, 3 data points is not a great deal to build a theory on. If a drug trial had 3 participants, it would not result in a licensed medicine. It would result in a conversation with the regulator. There is also a serious attribution problem. Every one of those cycles coincided with a number of other things: rapidly expanding retail adoption, easier on-ramps, new exchanges, historically low interest rates, and quite spectacular amounts of leverage sloshing around crypto markets, amplifying moves both directions. Every halving so far has happened during a broadly expansionary period for risk assets, which makes it rather difficult to say how much was the supply schedule and how much was simply the tide coming in. Nobody has separated the two cleanly, though a great many people have expressed certainty about it. The market has also changed underneath the pattern. Since January 2024, spot Bitcoin ETFs have allowed pension funds, wealth managers, and ordinary brokerage accounts to hold Bitcoin without going anywhere near a crypto exchange, and some corporate treasuries now hold it as a reserve asset. The supply mechanism runs exactly as designed, but an increasing share of demand now comes from institutions responding to interest rates and mandates and taking no view whatsoever on block subsidies. Here's the part that rarely makes it into the conversation, and it's easily the most interesting thing about the whole mechanism. The halving is designed to matter less every single time it happens. Look at what each cut actually removed. In 2012, 25 coins per block disappeared from new supply. In 2016, 12.5. In 2020, 6.25. In 2024, just over 3. In 2028, about 1.5. Meanwhile, the stock of Bitcoin already in existence keeps growing. So every halving removes a smaller absolute quantity of new supply, measured against an ever larger pile of coins that are already out there. As a share of total supply, annual issuance has already fallen to low single digits, and each halving now trims a fraction of that fraction. which leads somewhere slightly awkward for the theory. At some point, the supply reduction becomes far too small to move a market of this size, and if the 4-year rhythm keeps turning up long after the halvings have become mathematically trivial, then the halving was probably never doing the work, and what everyone has been watching is a sentiment cycle that happens to run on a similar clock. That is not a bullish claim or a bearish one. It's a structural feature of how the thing was written. The mechanism has a built-in expiry date, and it was put there deliberately. Which raises the obvious question, what happens when the subsidy reaches zero? Around 2140, the last fractions of Bitcoin are mined, and the block subsidy ends entirely. From that point, miners are paid exclusively through transaction fees, the amounts users attach to transactions to get them processed. This is an open design question rather than a solved one. Network security depends on miners finding it worth their while to keep the machines running. For the next century or so, that incentive comes mostly from newly issued coins. After that, it has to come entirely from fees. Whether fee revenue alone turns out to be sufficient is genuinely unresolved. It's the sort of question that gets skipped in most coverage, on the grounds that 2140 is a long way away, which is true and also not really the point. So, what the halving definitely is: a pre-scheduled, automatic, publicly verifiable reduction in new Bitcoin supply that materially squeezes mining economics on a known date. Nobody disputes this. It's in the code, and you can go and read it. What it might be: a meaningful driver of the price cycles observed over the past decade. What it isn't: proven. 3 completed cycles, thoroughly confounded by everything else happening in markets at the time, produced by a mechanism engineered to weaken with every repetition. The useful thing here isn't a forecast. It's that the next time someone tells you, with great confidence, that we're in year 2 of the cycle, you'll know precisely what's being claimed, which part of it is written in code, and which part is 3 data points and an unusually strong opinion. The counter keeps ticking either way. It has no idea what any of us think it means.